Hello everyone. Welcome to the June edition of Fixed Income Outlook and Way Forward. We have our senior fund manager Mr. Kaustubh Gupta with us. Welcome Kaustubh.
Thank you, Vinayak.
Kaustubh, taking the first question directly, the recent event of RBI monetary policy with a 25 basis rate cut. Your views on the same and outlook going forward.
So this is a third rate cut of 25 basis point, making a cumulative of 75 basis point of rate cut in this year. But this policy was with some bit of extra punch. Let me elaborate on that. In this policy, the voting for rate cut by 6-0 votes. Second, in this policy, instead of targeting a durable 4% inflation, RBI came back that they are targeting flexible inflation zone, which is 4 plus minus 2. Third, RBI realized that the monetary transmission is not happening effectively, and thus RBI clearly spelled out that in next 45 days they will set up expert committee and who will share their recommendation on the new liquidity framework. Fourth, RBI has revised their growth projection downward to 7% for FY20, but we think that there is a downside risk to it. Fifth, thus we can say that this policy is the ultra dovish policy in this RBI regime.
That was quite to the point, Kaustubh. Just as a follow-up question, was there any mention from the RBI in terms of crisis event or any sector-specific outlook that they are looking forward, and your views on the same?
So in post-policy con call, RBI clearly refused to figure out any specific action that they may be planning for the sector, but they clearly laid emphasis that they are closely monitoring the situation and they will make sure that the financial stability of the system is not being questioned at all.
Kaustubh, with this event of 25 basis rate cut in the recent monetary policy, any specific triggers in the portfolio in terms of changes that you would have done and would like to share this updates?
So with 3 rate cuts of 25 basis each and change in instance to accommodative, clearly now RBI is targeting that the policy transmission happens in an effective manner. And thus we think that up to 3-year corporate bonds, they look quite lucrative. As liquidity starts sweeping into the system on account of RBI actions, the liquidity premium which is inbuilt in these 1 to 3 year corporate bonds, they will start unwinding. And we suggest investors to add some bit of duration in that. Another reason is that in over next 1 month, as the new mark-to-market guidelines rolled out, we think that the liquid funds YTM will fall off quite significantly. Does it make sense for the investors to start moving away from liquid fund to various other categories of fixed income products?
So Kaustubh, when you mention about adding some duration to the portfolio, any specific strategies that you are advising to our investors to look forward?
So investor who doesn't want to add any significant duration risk, I would suggest them to start moving for durations which are up to 1 year products. For example, money market funds, ultra short term funds and low duration funds. For investors who have longer visibility and patience, they can move to banking and PSU funds and corporate bond funds. We think that these funds which invest predominantly in AAA corporate bonds, as the liquidity spreads unwinds, they are likely to give reasonable amount of capital appreciation along with elevated YTMs at which the markets are trading.
Thank you, Kaustubh, for sharing your valuable time and inputs for this edition. We hope to see more in the coming months. Thank you, investors, and happy investing.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.